Hey guys, excuse the background because I'm on vacation right now, but I felt like this news was just too important not to share. The odds of the US going into a recession has undoubtedly increased, and here's why. The Consumer Price Index measures changes in prices paid by consumers for goods and services. It includes food, clothing, shelter, fuel, transportation, just everyday expenses like doctor's visits, going to the grocery store, things like that. The CPI is one tool the feds use to measure inflation. The recent CPI report shows an 8.6% increase over 1 year. That is really, really bad. That is the highest inflation has reached in over 4 decades. So if you're 40 years or younger, then this is the highest inflation you've ever experienced in your entire life. Let me just repeat that is not good. But don't worry, because when consumer prices rise too fast, the Fed comes in to save the day by raising interest rates. Small changes in interest rates have a huge cascading effect, so even just a tiny increase of 25 basis points is going to have a really big impact in the financial system. So when rates are changed, it has to be done with caution, otherwise it can get pretty ugly. Think of it this way. Moving interest rates is like landing a plane. You want it to be smooth the entire way down. You don't want a bumpy ride. But if you change the trajectory really fast, it's going to be really, really bumpy and very uncomfortable. Or even worse, a crash landing. Last week, Jerome Powell increased rates by 75 basis points in an effort to halt inflation and stabilize pricing. This was the largest rate increase in 28 years. That's a lot. So what does all this have to do with the recession? Well, it has a lot to do with it. The Fed's job is to promote maximum employment, stable prices, and moderate long-term interest rates. Now, usually smaller rate increases, like 25 basis point increase, will help stabilize pricing and keep inflation down. But a lot of people are concerned that that's not going to happen this time around. That's because of the way the CPI is comprised. Caution, this is a nerd alert. When we look at the CPI, there's a headline CPI and core CPI. Headline CPI includes all of these things here, while the core CPI excludes food and energy. Food and energy are priced with external factors like supply and demand, weather, how much a crop yields throughout a year. The Fed can't manipulate those prices by moving interest rates as much, so they really just strip that out of the core CPI. Of core inflation, over 42% was due to housing and auto. That's a very large percentage. Now keep in mind, the Fed has a goal of inflation being around 2%. If every other category had 0% growth, except for housing and autos, then that would be 3% annualized inflation, still above the Fed's 2% goal. If the Fed wants to get to 2%, they need to destroy demand everywhere else. And here's another tricky part. The Fed doesn't even have that much control over the auto industry. They may raise rates, it may be a little bit more expensive for consumers to purchase a new vehicle or a used vehicle, get an auto loan, but moving it a couple percent isn't going to change the whole dynamic of the entire industry because that industry is worldwide. You know, we're dealing with other countries that are demanding their consumers purchase electric vehicles or hybrid vehicles within a short period of time, which means there's going to be a really big transition. So that's going to affect the automobile market. It's also going to affect commodities. That would mean the Fed has to focus on the housing market, raising rates so high that people aren't getting as many mortgages. And when people aren't getting mortgages, there aren't as many jobs being produced. The National Association of Realtors projects that there's 1 full-time job for every 2 houses sold. So when there are less houses being sold, that means less full-time jobs. And that could be anything from a handyman to a painter, a roofer, a contractor, somebody working in a manufacturing company building fridges, ovens, stoves. All those things have a trickle effect because of the housing market. Now, there's a real possibility that the Feds could have somewhat of a soft landing if they slowly reduce the amount of demand for housing. But the thing is, it's a very tricky job. Again, making very small changes in interest rates has a very large cascading effect in terms of the entire financial system. And we just had a huge increase last week. If the Fed is magically able to reduce the amount of demand just enough so that it can cool things down, we should be in an okay spot. It's a very tough role for the Fed to play. I'm not as optimistic this time around. I think things are going to get bumpier than what people are initially expecting and what the Fed's expecting. Do I think it's going to be 2008 all over again? Definitely not. Do I think it's going to be a bumpy ride? 100%. So I think it'd be very smart for investors to be cautious in this time. Make sure that you're saving up some cash reserves. Make sure that you're investing consistently. Look for opportunities and don't just dive into really aggressive investments. Be more cautious than you have been the last 10 years. You've got to prepare, you've got to invest wisely, and you need to plan strategically throughout this next year. I think it's going to be crucial for investors who want to see a consistent return over the long term to be positioning their money properly and saving on the side as an emergency fund. So that's my advice. That's what I really want to break to the table, guys. I'll be back next week with another episode. Feel free to leave a comment, questions down below. Don't forget to hit that like and subscribe button. I'll catch you guys next week.